sale program, remember, begins not with a spike in the PREM, but before the spike takes place. That's what causes the spike in the PREM. Remember, this here isn't the sell program. This is the market makers detecting the sell program. You see the difference? So the sell program actually originated in here. That's where the sell program came in. So when the market maker detects the sell program and they pull away their bids, the PREM drives massively to the downside, and the stocks, the futures, make their profit. And that creates what is sometimes called the arbitrage trade, which has got nothing to do with the buy program or the sell program, but is in most cases a result of a buy program or sell program. So if you were going to trade that as an arbitrage, the idea would be to buy into that storyline at the arbitrage level. Because if you give away the tick at that stage, you're giving away too much profit. Now, sometimes you get an opportunity to buy or sell following those areas as well, which is what we covered in the several PREM classrooms that we've done in the last short while. But if you just took those trades, those arbitrage type trade areas, if that's all you took, could you still make some money with a reasonable size stop, or would you get absolutely annihilated by these buy or sell programs? Well, we've got a little period over 8 minutes there. I mean, it is only an 8-minute period, but it's a recent 8-minute period. It's going back 15 minutes now since these highs and lows were put in. So we can take a look at those and we can ask the question, what size of stop would you have needed to have survived these areas? And secondly, did they make any money? If we look at these trades on the S&P, you can see them for yourself. You could have bought in there, and you can see that you got a reasonable profit for your troubles. You could have sold in here, and so long as you used a reasonable stop, let's talk about what reasonable is, 40.25 with a high price of 41.25, so you'd have had to have run a 5-tick stop to have survived that one, right? 5 ticks would have been required on that stop to have survived that drawdown. On the other sell trade, you can see that you never had any drawdown at all. On this buy trade, you can see we got a little bit of trouble. You can see we actually ended up going down through that phase. That was 37.25, traded 35.5. So 5 ticks would have taken you off that trade as well. Okay, so you'd have lost 5 ticks on that trade. We got another buy trade here that had no drawdown, pretty much no drawdown, depending on whether you got that price or not. And you still made some nice money, didn't you? This sell trade here, you can see what happened. 38.75 with a high print of 39.75 for 4 ticks. So your 5 tick would have kept you inside your stops again there, and you got a very good profit from that one. This trade here, you probably got a good enough chance to scratch out at some stage during that phase. And then this buy trade made you a lot of money. So you've only had one losing trade with 5 ticks. One losing trade with 5 ticks. And you've had 1, 2, 3, 4, 5, 6, 7, 8 trades. So you've had 7 winning trades and 1 losing trade. Some of those wins might just be scratches, but nonetheless, you can see that you are building a fairly profitable, consistent book just by trading the arbitrage element of the PREM. Now, it's not quite arbitrage to the extent that you're going to get massive inflows of arbitrage funds coming in from the commercials. But you get the basic idea that buying or selling a discount or a premium is still something you can do. But remember, the point about this is you can actually eliminate almost one side of the trade here by looking at things like sentiment. By looking and understanding concepts like sentiment, advanced decliners at highs, lows, and the like, you're able to take out some of these trades that might not have cost you. For example, this buy trade here. You might have looked at that and says, well, why would I buy that one when you can see the sentiment is so low? So would you have taken that as a buy trade and lost 5 ticks? Or would you have passed on that as a buy trade? What do you think? You'd have passed, wouldn't you? You'd have passed on this buy trade here. You would never have been anywhere near that with the sentiment so bearish. So in other words, you wouldn't have had that 5-tick losing trade off of that PREM trade there, would you? That would never have even have been in your considerations because you were able to eliminate the trade because you are trading one side. So what trades would you have taken out of all of those? Well, this trade was probably valid because at the time, the sentiment was actually bullish. So that trade was probably valid and it did only scratch you. So I mean, you only got a +1 on that trade or a 0 even. This trade, well, there's a nice sell-side sentiment. There's a bit of a bull coming in, but you're still getting a reasonable bit of value in that trade, a reasonable bit of value. So I think that would be a reasonable sell. Likewise, the next sell was definitely okay to take, so that would have definitely got into your books. This buy was a non-starter. This next buy was a definite buy. Yeah, this sell would have been a definite sell. We've got value divergence on that sell, yeah. This buy, definitely questionable. Would you agree with that, Subra? Kuba? Alan? That's a bit questionable. The value's made a lower low. The price is just into a lower low. So I would imagine I would probably be looking at that saying, you know what? It's not good enough. What about this buy? Is that questionable or not? Is that buy trade there questionable, the last one? No, it's a straightforward buy trade, isn't it? That one is a straightforward buy opportunity to get straight into the markets. Now, bear one thing in mind, guys. These are 5-second charts. So these are fast money moves. So you're making probably no money on that trade, right? You probably made no money on that trade. In terms of this trade, 40.25s traded at a low price of 38.25s. You could have made $100. That could have been possible. Now, that's obviously the maximum swing, so we're obviously just putting in the maximum swing for you here. So you could have made $100 on that trade. On this trade, 40.5, 36. That's not bad, is it? So $200 maybe on that trade possible without an awful lot of effort. So possibly a $200 winner there. What about this trade? 36 quarters traded, 37 quarters, $50 before you get scratched out at +1. So $50 before you scratched at +1. The sell trade at the top edge, 87 down to 33.7. So you're looking at 87 down to 3.7. You're looking at 5 points. You're looking at $250 on the maximum swing. On a maximum swing basis, another $250 on that one. And then this last buy, how did that last buy trade do? Well, it depends where you took it to, right? Depends where you took it to. So based on that buy trade, obviously there's a lot of areas, but that wouldn't have been an exit necessarily. That might have been an exit in there. So realistically, 40.75 from 33.75, 7 points, $350. I don't think would have been unreasonable to say $350 profit on that trade there. So bearing in mind this is a 5-second chart, bearing in mind that was a 10-minute period of time, and bearing in mind we're doing one contract trade swings here, you can see that potentially you could have had $3, $4, $5, $6, $7, $8, $950 per contract for that 10 minutes. Potentially. Now, obviously, we always tell you that if you do the maximum swings, that's how much money you would make if you traded 3 contracts, okay? So if you were a 3-lot trader, to make $950 is your base target price. So obviously, if you were a brilliant trader, the maximum you could make on 3 lots is going to be 3 times that. So you could have potentially made about $3,000 during that 10-minute period on 3 contracts if you are the very best trader on the planet of all time ever. But that would have meant you'd have been required to buy the bottom tick price and sell the top tick price on every single one of those trades. That's not going to happen. But your baseline entry would have been that you'd have made $950 per 3 contracts during that period. Now, even that, if that's how much you can make for 10 minutes work on a 3-lot, I think you could be very, very happy with your business. If you could make $1,000 every 10 minutes on a 3-lot, think about the fact that that's going to be adding up quite nicely to about $2,000 an hour trading 3 contracts. And that's obviously taking big gaps in between. That's taking breaks. That's taking some business. And if you were able to do that right through the whole period, you're looking somewhere about $5,000–6,000 per hour. If you were consistent, if you were able to stay at your desk the whole entire time, but realistically, it gives you a target of about $2,000 an hour. Top line, probably as much as $5,000 an hour, based on 3 contracts, remember. It's not a bad target to make, is it? It's not a bad target to go after based on some of this basic trade idea and basic trade assumptions. And it's basically what we did pretty much all morning on the DAX. And it's what we're obviously looking at here on the S&P, which is why we keep coming back to that PREM. That's why we keep coming back to that PREM. You know, because it's such a good value line to find that life just gets better and better with it. And when you look at the context to that bullishness, you really do see how bullish this bottom edge became for the buy side of your equity markets. It really was quite a strong bullish sentiment narrative that evolved in there, wasn't it? So I don't suppose it was a massive surprise when the bids did rip into the markets through that phase. Sexy like a box of chocolates, guys. By the way,